Welcome. My name is Peggy Crawford, and I'm Professor of Finance at Pepperdine's Graziadio School. For the next few minutes, we'll be discussing reaching your financial goal and value creation. But before we do that, let's think a little bit about who should benefit from the operations of your company. First, should your customers benefit? That is, should we create a quality product that at a reasonable price that meets the needs and our desires of your customers? And next, your suppliers. Should we create enough funds so that we can pay them for their services in a timely fashion? Your employees. Should we be able to compensate them appropriately for the time and effort they put into the company? Your creditors. We want to reward them for the risk they're accepting by loaning us the money. And then the government. We always want to pay our fair share, not more, but our fair share. And lastly, our owners. What are we going to do for our owners? How are they going to benefit from the firm? So which of these should we be in operation to benefit? Actually, all of them. If we're going to maximize the value to our shareholders, then we're going to have to provide value for all of our stakeholders. Well, what does this entail? It's pretty simple. We start out by raising money, and that's where those creditors come into effect. Then we're going to invest that money in assets. That's where some of our suppliers come in. Those assets then are going to produce the good or service that we sell. That provides our revenue, and that's where the customers come in. And then we're going to manage those expenses so that we can maximize the returns that we're earning. And managing those expenses involves our employees, our suppliers, and our creditors. So that's what we're going to be doing. Well, how do we operationalize this? Think about a balance sheet. On the one side of the balance sheet is our liabilities, owner's equity. This is where our money comes from. Other side shows the assets. This is where we're investing that money so we can produce that revenue and be able to sell our product. Let's look at liabilities again. Really just two sources of funds. There's debt and there's equity. Now within that, there's a wide variety of instruments. For example, we could have accounts payable, and this is where we buy on credit from our suppliers. We could have short-term debt, intermediate debt, long-term debt. And then I've divided our equity into two sections. One I call externally generated equity, and this is money we bring in from the outside. For a small company, it could be the money we invest, our family invests, our friends invest. As we grow a little bit larger, it could be money from angels, from venture capitalists. And finally, when we go public, this is the money we raise as we sell stock to investors. Now, the internally generated is a little bit different. Let's think about the income statement. We have that revenue. We're controlling those expenses. That's giving us our earnings before taxes. We're paying our fair share of taxes, and then we're left over with net income. Two alternatives of what we're going to do with that income. We can pay it out to our owners. Our owners can then use it to reinvest in something or to spend. Or we can retain that in the company to help support the assets that produce our sales. Now, if we retain it, there's an opportunity cost associated with that for owners. They have to postpone their expenditures on either goods or on reinvesting. So let's go back to that balance sheet. Looking at those liabilities and owner's equity, everything has a cost. Debt's not free. We have to pay interest on that. Equity's not free, whether it's internally or externally generated, because our owners are expecting some kind of return for that investment that they're making. So we look at those assets, and those assets then have to return a higher amount than those funds are costing us. That's how we create value. Or looking at this simple little chart, we can kind of conceptualize it by thinking about return on invested capital. And this is two parts. It's that profitability that we make from investing those assets and making earnings on them. And the more efficiently we use those assets, the higher the amount of money we're going to make. Now, to make that into a return, we're going to divide that by the amount of external capital that we've had to raise. And again, the bigger the bang for the buck we can get, the more return each of those dollars can generate, then the higher will be that return on invested capital. But there's cost associated with that investment capital, and that's our weighted average cost of funds. So to maximize value, we want to maximize the difference between those two. So what does this mean? Well, we want to manage those financial statements. We want to manage that revenue, those expenses, and we want to manage those assets and liabilities. We want to set up our liabilities owners equity section in such a way that we're lowering our average cost of funds. We want to take that money and we want to invest it in assets, enough to support our sales, but not too much so that we're lowering the return to our owners. So what do? Manage our financial statements. That then will create value, reach your financial goals. Thank you very much.